Hi students, this is Mr. Jason. Right now we are still in the topic of ratios, and this is the fourth category of ratios which I'll be covering now. So in the previous videos on ratios, we have covered liquidity, stability, and also profitability. And in the profitability ratio, we already talked about three different ratios in that category. For market ratio, which is the fourth category, there are also three market ratios to look at. Yeah, so basically market ratios are something that investors are really keen in looking because it talks about the marketability of the company. Yeah, so let's look at the first ratio, which is earnings per ordinary share. So for earnings per ordinary share, what this means is the portion of a company's annual profit after tax allocated for each ordinary share. Yeah, so the formula is profit after tax divided by the weighted average number of ordinary shares issued. Now, in the previous video, we did talk about the weighted average, and that was a simple average. So this average is weighted, and the way you calculate it is slightly different. Now I'll show you how to calculate this based on an example. So if you look at this example here, so they told you about the information on the ordinary share. There's also preference shares, but preference shares are not very important in this formula. And you look at 1st of April, they issued a further 11,000 ordinary shares. That's during the year. And then 30th June, this is the profit after tax. Yeah, so profit after tax is already given. So this is fine. Now the problem is, how do we find this? Let's look at it. So they've given you the earnings per ordinary share for the previous 2 years, and they want you to calculate for the year ended 30th June 2018. So this is more like a comparison base. Yeah, you basically need to compare your answer with these two amounts to see whether the trend is going up, down, or is it the same. Now in your solution, let's look at the solutions. So basically what happened here is you had 62,000 shares from the 1st of July till the end of March. The reason why you have to calculate it like that is because from the 1st of April, there is an 11,000 ordinary shares that has been issued. This is in addition to the current shares you have. So currently you have 62,000. But after adding 11,000 from the 1st of April to 30th of June, you will end up with 73,000 shares. So what I'm doing here is I'm trying to weigh the average by finding out how many days do I actually have this number of shares, and how many days do I actually have this number of shares. So just a simple calculation. How do I get 274 days? Basically, you need to find out how many days were there from 1st of July to 31st of March. So it basically works like this. July, there are 31 days. August, 31 days. September, 30 days. October, 31 days. November, 30 days. December, 31 days. January, 31 days, February, 28 days, and then March, you have 31 days. Yeah, so the total for all those days would be 274. How do I get 91 days? This is easier because there are only 3 months, April, May, and June. Yeah, so April, there's 30 days, May, there's 31 days, and June, there's 30 days. So the total would be 91 days. Yeah, so when you want to weigh the average, what you do is, for 274 days out of the 365 days, you have 62,000 shares. So you times it together. So this is the weighted average for that period. Then for the remaining 91 days out of the 365 days, you would have 73,000 shares. So that would add up or weigh. The average would weigh at about 18,200 shares. Then you add these two up, that would be your total weighted average number of ordinary shares for the whole year. Once you get this answer, then you can easily use the earnings per share formula, which is the profit after tax divided by the weighted average number of ordinary shares issued. 22 cents per ordinary shares. Okay, you want it to go up every year. So when you compare it to 2016, 2017, and then this year, 2018, you would see that the trend is increasing, and this is a strongly approved rate by the shareholders, which means a good thing. Yeah, you don't want your earnings per ordinary share to decrease each year. Now, for the second ratio called price earnings, so this is the number of times of earnings per ordinary share that an investor is prepared to pay to purchase an ordinary share. So how do you calculate? You take the market price per ordinary share, you divide it by the previous formula's answer. Yeah, so let's say you already have your earnings per ordinary share at 18 cents. then your market price is $2.52. You just need to divide these two, you get 14 times. Note that the unit for this answer is also in times. So what it means is that the ordinary shares of this company is currently selling at 14 times the earnings per share. How do you interpret this ratio? Now, when it is high, it indicates that the investors are very confident in the company. They believe that the future growth of the profit is very good. But it also may mean that the investor is overconfident, because it doesn't reflect the actual reality. It is more of a perception. A lower price earning ratio, it means that the investors have lowest confidence in the profit growth prospects of the company, but it may be an underestimated amount. So we can sometimes call this high price earning ratio as an overvalued amount, and this can be an undervalued amount. Let me look at more details for the interpretation. If the ratio cannot be calculated, then the company may have losses or no earnings at all, which is 0. So you will have an undefined ratio mathematically. If it is 0 to 10, then we can say the stock is undervalued, or the company's stock is actually in decline. The earnings are in decline. 10 to 17 is usually considered a fair value. If it is 17 to 25, then the stock can be overvalued, and they can call it as a growth stock as well, because customers or investors are generally very confident in the company's performance. But if it is more than 25, then sometimes we can say that there is a very, very high expected future growth in earnings. It may be subject to a speculative bubble, and the problem with the bubble is that it may burst. Okay, let's go to the final ratio for this category. For dividend yield, so dividend yield basically measures how much a company has paid out in dividends relative to share price. So the formula for this is annual dividend per share divided by market price per share. Please note that we are only using ordinary shares because preference shares calculation is not required in the syllabus. So usually an investor compares the answer for this ratio together with interest from a bank deposit or even interest or dividend from other companies. Let's look at an example. So let's say Alan has 3,000. He is thinking about investing in either buying shares in Westco Limited or depositing the money in a fixed term bank deposit, which will give him at about 6% per annum. Now, the information given for Westco, annual dividend is 16 cents, market price is $2.52. So when you want to calculate the dividend yield, is easy. Just take the annual dividend per share divided by the market price per share times with 100, you get 6.3%. This would be higher than the interest rate gotten from a 1-year fixed term bank deposit. And this means that based on the numbers alone, you can see that the dividend yield is higher, so you will get more returns if Alan purchased share in Westco Limited. However, please note that this analysis ignores two things. It ignores capital growth or capital losses. It also ignores risk. Because you see, fixed term bank deposit is safer generally. And the thing about shares is that the fluctuation in share price is very, very likely. So it's very important to diversify your investment. So a principle that any investor needs to adopt is diversification. They cannot invest everything in one basket. So if let's say you're Alan, what would be a wiser choice is instead of choosing either one, you should maybe invest in both. Put some money in the fixed term bank deposit and some in Westco Limited's dividends, because that would then be a diversified investment rather than putting all your money in one portfolio or one investment option.